Hi everybody, welcome to this revision webcast for AS Microeconomics, and tonight we're going to be looking at two really key government interventions in markets: indirect taxes and government subsidies. The exam is just over a week away. I'm sure your revision is in full pelt, and hopefully in the next 25-30 minutes I can focus in on the key diagrams, the key questions, the important issues that relate to both of these interventions in the market. So we're going to kick off tonight by looking at indirect taxes. Well, it's important to define terms well. Indirect tax is a tax clearly imposed by the state. But the key point here is it's a tax on the producer. So indirect tax is going to add to the supply costs faced by a producer of a good or service. And the crucial point when he's showing the diagram is that the level of tax is indicated by the vertical distance between two supply curves. We'll have a look at that in some diagrams in just a few seconds. Because of that tax, the key point is that producers are not willing or able to sell as much at each price level. So the normal effect of a tax is we see the market price go up, and we normally see a movement up the demand curve, a contraction of demand to a new equilibrium with a higher price and a lower output. Notice at the bottom here, I'm giving you a really good exam tip. These analysis diagrams, when you're showing intervention in markets, absolutely vital. You produce great diagrams. Please make them a good size. I suggest at least a third of A4 as a kind of minimum. Okay. So there are two main types of indirect tax. I'm sure you're familiar with this in revision, but let's just revise it anyway. First of all, there's something called a specific tax. And that is where the tax set is fixed per unit. So, for example, you might impose a £5 tax on the producer. That £5 is every unit sold. Conversely, we could impose a percentage tax, an ad valorem tax. We could add 20%, for example, on the unit price of a good. Easily the biggest source of revenue for the UK government from indirect tax is from VAT. That generates over £2 billion every year in tax. Fuel duty is perhaps the next biggest one. Look at the difference there. It's only a quarter of the revenue, things like petrol duties. And tobacco taxes, well, they bring in a fair amount, £10 billion per year. That's only 1/10 of the money that's generated from VAT. And that's quite a useful, hopefully, contextual evaluation point. Governments are looking to raise extra tax by lifting indirect taxes, for example. They should really focus on the big revenue generators, and VAT is way out ahead there. That gives you a flavour for what the main taxes are. And there are some examples. It's just always good to go into the exam with just some good contextual awareness. Sometimes you give them the data, you can use it. Oftentimes you can bring your own knowledge into a question. So VAT, the standard rate is 20%. That went up from 17.5% a few years ago. It's not all on VAT is not always 20%. For example, it's just 5% on fuel. That's the minimum EU rate of VAT. Landfill tax, different type of tax. This is a duty. This is £80 per tonne for the waste which is sent to landfill sites. And the idea behind that was to try and get more people to recycle their waste, both household and industrial, but there's been some unintended side effects. Fuel is in the news, obviously. The government has actually frozen fuel duties in recent years, but Britain has amongst the highest petrol and diesel duties in the European Union, currently taxed at nearly 60p per litre. And then we add in the taxes that some of you might be familiar with. So beer at the moment is taxed at 41.5 pence per pint, although the tax on lower strength beer, which I'm sure you use, is less than that. And I know none of you smoke. None of you smoke. You're too busy revising. But if you did, think about how much tax you'd be paying on a packet of 20. £3.76 in duty plus 17% VAT. The vast majority of the price you pay if you smoke is duty plus VAT. And that's enough to leave cigarette smokers fuming. Air passenger duty is another key tax. This is being reformed at the moment. Keep in mind some recent changes. So, for example, kids under the age of 12 flying within the EU will no longer have to pay air passenger duty. This is basically a duty applied on flights within the EU, short haul, and of course things like transatlantic. The rate of tax you pay is based on the distance of travel. So these are some of the examples of indirect taxes in the UK. How do we show an indirect tax on a diagram? Look at our first diagram here on the left-hand side. This shows the effect of a tax when the demand curve is drawn as perfectly inelastic. PED is 0. If we impose the tax from S1 to S1 plus tax, we see that the market price goes up from P1 to P2. And in fact, there's no change in quantity. All of that shaded area is tax revenue to the government. The whole of the tax is paid for by the consumer. If you want to raise serious revenues, then you should really be taxing products with a low elasticity of demand. Contrast that with a tax where the supply curve is perfectly elastic. This will be an industry where the cost of supply is the same for all units. Again, here we put a tax on. So we go from S1 to S1 plus tax. And notice again that the consumer will pay all of the tax in this example. But depending on the elasticity of demand, there will be a fall in the equilibrium quantity consumed. And in my diagram on the right-hand side here, I've drawn the demand curve as fairly inelastic. So quite a big tax per unit is leading to only a relatively small change in quantity consumed. Here's another example of a tax. Again, what I'm doing here is I'm just changing the elasticity of demand. So in this case, I've drawn the demand curve as fairly elastic. PED is greater than 1. Notice here that if we have a tax, there is quite a big change in quantity. We fall from Q1 to Q2. A fairly modest change in the price from P1 to P2. What that means is the consumer pays the orange bit. They pay the higher price. But the producer, because demand is elastic, they have to absorb the tax in the form of lower profits, lower revenues. The government will get the tax. Orange plus the green area is the total tax. In this case, the producer has to absorb a lot of the tax. And in this example, we see a contrast. On the right-hand side here, the demand is inelastic. And for the same tax per unit, S1 to S1 plus tax, we see a bigger price rise, a bigger orange shaded area that's paid by the consumer, and a smaller area paid by the producer. The key point here, often tested in multiple choice, is that when demand is inelastic, it's the consumer that tends to pay most of the tax. But when demand is elastic, the producer has to absorb it. These are the kind of analysis diagrams we want to draw on the exam. Really clean and clear, with a very, very few arrows to sort of mess things around. Keep your diagrams to a high level, and you'll impress the examiner when they receive your scripts online. The other tax we just need to cover briefly is the ad valorem tax, the percentage tax. Best example, of course, is VAT, 20%. Notice on the left-hand side, because the tax is a percentage, the lower the market value, the lower will be the tax per unit. So if you have a 20% tax, the supply cost is £50, you add £10 on a 20% VAT. If the price is £400, then you add £70 on with VAT. The higher the price, the greater will be the level of VAT applied. That diagram is an ad valorem tax. Interestingly, in the exam a couple of years ago, they asked a multiple choice question where they wanted you to show the effect of a fall in VAT. A fall in VAT. So what you do in this diagram here is you reverse the shift in the supply. You go from S1 down to the lower supply curve, but keeping that pivotal change. Let's move on to evaluating the effects of indirect taxes. Oftentimes we'll get a really key question: assess the case for a tax on X, or discuss the arguments for and against a government intervening in the market. You want to talk about taxation as an option. So here are just a few thoughts on how you can evaluate and assess the likely impact of a tax. But keep in mind that economics is a social science, and we can never guarantee how people are going to respond and behave in response to intervention. The first key issue to ask is, does the tax work? Can't stress this enough, everybody. Use the word effectiveness when evaluating a policy. Does a specific policy actually work in meeting its achieved aims? So, for example, if we introduce a carbon tax on CO2 emissions instead of, for example, carbon trading, does a carbon tax work better in changing the incentives and the behavior of businesses who are polluters? Or would another policy work? So challenge the effectiveness. And secondly, are there any unintended consequences? So if we tax in one market, do we then create spillover effects in related markets, or unintended behavior that we didn't quite anticipate? Second key evaluation question to think about: if we put a tax on a product, how much revenue, how much tax does it actually create? So, for example, we know from the analysis a few minutes ago that an indirect tax is more likely to create tax revenue. But another key question, many students miss this out, is even if we do have a lot of revenue from the tax, how is that money used? So perhaps, for example, a carbon tax could raise a few £billions, and the money could be used to fund renewable energy projects. Or, for example, we could raise the tax on landfill for businesses, and the money used could fund apprenticeships, training programs for long-term unemployed. It's always really good evaluation to think about not just that the tax raises revenue, but to make a comment on how that tax is actually used. Third issue is what are the wider consequences, particularly for those for whom the tax is applied. One of the issues, for example, with a carbon tax, or if we increase the rate of VAT in the UK to 25% after the election, is the worry that British businesses would somehow lose out and lose their competitiveness, for example, in the European market. Is there a danger that if we tax heavily at a micro level, we lead to some negative effects on jobs, investment, and trade at a macro level? It is a good idea in a micro paper just to think about some of the macroeconomic consequences of a government intervention in the market. And fourthly, and this is incredibly important, particularly if you're taking an Excel exam, think about the consequences, the likely effects of an indirect tax on different groups within society. Who are the main winners and losers? So, for example, if we put a tax on high-fat food, or if we raise the duty on cigarettes, or if we change the taxation of housing, who are the winners and who are the losers? Does it have a progressive effect, where the burden falls more heavily on better-off families? Or does it have a regressive effect, where the burden of the tax actually is felt most heavily by families at the lower end of the income scale? I hope this slide, if you go through it again after my presentation, will really give you a steer as to how you can evaluate indirect taxes. You don't have to use all of these arguments. You won't have time in the exam, but certainly some of them would be really useful to build up a great answer. Let's now move on to the second part of this revision webcast, which looks at government subsidies. Subsidy is basically any form of financial support provided by the state. It could be local government, it could be national government. Subsidies helping producers and or consumers. Just let me take you through some really good examples. You'll be given some presumably in a stimulus question, but here are some examples to think about. Here are two environmental subsidies. Top left is the subsidy often offered by several governments to farmers to grow biofuel, hopefully as a sort of alternative to petroleum. The US government, for example, offered quite generous biofuel subsidies for farmers. On the other hand, a subsidy for consumers, the so-called feed-in tariff. This is where consumers could put solar panels on the roof and generate energy, and any surplus energy created could be fed back into the national grid, and consumers got a payment for doing so. It proves to be very popular in the short term. Here are two more examples of how we might subsidise. So the government could provide funding and financial support for apprenticeships for the long-term unemployed or for young workers. And again, think about the macroeconomics of that with youth unemployment running so high. In a recession, a state might decide to provide some form of government aid to loss-making businesses, such as a loss-making airline. Happens a lot in the EU. And there were some other examples, so wind farm subsidies, very much in the news. In some countries where the price of food and fuel is very expensive, governments may be tempted or have to provide some subsidies for consumers. And here are two other good examples, topical examples you might want to think about. To what extent, for example, should the government provide financial support for working families so that childcare becomes more affordable? Should the government continue to offer subsidies to the rail industry? Who are the winners and losers in those situations? So subsidies are topical, and there are really lots of really good examples you can think about. How do we show a subsidy? Let me just take you through the basic diagram first. If you offer a subsidy to producers, the effect is to reduce their costs. This brings down the market supply curve, and the amount of the subsidy is shown by the vertical distance between the two supply curves. So in theory, a subsidy to producers causes an outward shift of supply, a fall in the equilibrium price, and an expansion of the equilibrium quantity. That's the basic subsidy diagram. I'm sure many of you are familiar with it. However, it's not the complete diagram. The crucial point is to then explain how the producer benefits. So if we go back a slide, P2 is the price after the subsidy. The producer is willing to charge P2 because they know that they're going to get the subsidy on top. They can produce Q2, they will charge P2 to consumers, they'll get the subsidy on top, and they'll receive the price P3. So that red, blood red shaded area is the total spending by government on the subsidy. So why subsidize? Often in these kind of exam questions, you're asked to make the case or evaluate the case for some kind of financial support. All kinds of reasons. The top left really thinks about equity issues. So to what extent are subsidies useful for improving accessibility and affordability for things like childcare and basic foods? Governments may want to expand growing sectors such as renewables, and that could help along the way. They may want to protect jobs, industries hit badly by recession, or businesses facing up to structural change. Some governments, for strategic reasons, may want to protect employment. In the health industry, it may be the case that certain drugs, certain treatments are basically out of the reach of most people. A subsidy can help to make them more affordable, and there might be some externality issues there. The government is clearly concerned about long-term unemployment, so cutting the cost of training or subsidizing businesses who take on the long-term unemployed could be an effective, efficient, and equitable policy. Effective, efficient, equitable. And that leads me on to equity. Oftentimes subsidies are introduced because the government wants to improve affordability and access to key public services for people on below average incomes. And other kind of reasons may be the case that the government thinks that, for example, bus travel is going to reduce emissions more than, for example, reducing car use. They want to bring down some of the external costs of transport. And there could be the case, for example, for subsidising the arts, theatre, opera, creative arts, partly at a micro level because of the externalities involved, but also because of the macroeconomic effects. Britain, for example, is the biggest exporter of creative services in the world. So here are some of the justifications for producers for giving financial support to certain industries. What's the effect of a subsidy? Again, the consequences depend on the elasticity of demand and the elasticity of supply. So in this diagram on the left-hand side here, we've offered quite a generous subsidy. The price has fallen from P1 to P2, but actually demand's inelastic. So we don't see a big rise in quantity. It nudges up a little bit from Q1 to Q2. Whereas in this second example on the right-hand side, the same subsidy, S1 to S2, has a much bigger effect on quantity because here the demand's more elastic. And this will be a good example of where the government trying to encourage consumption of something, for example, a merit good, might try and subsidize things where they think the consumer demand is price sensitive. Again, look at these diagrams, everybody. They're clear, they're accurate, and the most important thing is they tell a story to the examiner. Can't emphasize enough how important your diagrams are. Well, finally, again, let's evaluate. Let's try and critically assess the arguments for and against subsidies. Notice here we're following a similar theme to taxation. We're asking a question: are the subsidies actually effective in meeting the prescribed aims? Will a subsidy, for example, for renewable energy, will it lead to a significant increase in supply? Is a subsidy on its own enough? So, for example, the government might subsidise childcare, but might it also have to increase its own spending to improve the training of childcare workers? Or, for example, some kind of leasing subsidy to childcare businesses to make more businesses available. Sometimes a subsidy on its own is not enough. You need a combination of policies to have a bigger effect. Second important question is whether if you subsidise a business, you might actually have an unintended consequence. On the negative side, businesses that are in receipt of a subsidy, well, they may become overly dependent on state aid, and they might become inefficient as a result. Equally, a well-targeted subsidy, for example, subsidising research and development, could actually bring significant positive externalities, positive spillover effects, and increase productivity in the long run. What I'm suggesting here to you is that evaluation often comes from asking a question. So, will a subsidy boost efficiency? Well, it depends on. And just asking a question and then saying it depends on, you're building stronger evaluation into your answers. Question which a lot of students put into their answers, and it's absolutely fine, is to raise the issue of how much does a subsidy cost? What's the total spending by the government? Is the subsidy part self-financing? So, for example, if you subsidise long-term unemployment training, ultimately that's less that the state has to spend on welfare. Perhaps a subsidy will create new jobs, new investment, and that in the long term is going to bring in more tax revenues. So subsidies could be part self-financing over the longer term. Or if you take a slightly more critical view, if you subsidise farmers, you subsidise fish farms, you subsidise loss-making airlines and rail companies, you end up actually creating a much bigger burden for taxpayers, not necessarily now, but in the future. And we'll be bringing the idea of opportunity cost there. And a fourth question is, I think, really quite important. Go back to the issue of market failure, because presumably the argument for introducing a subsidy was linked, at least in part, to one or more market failures. So, for example, if you offer a childcare subsidy, does that lead to a better childcare being provided and more of it? But crucially, does that lead to more people finding work? Does a childcare subsidy help to reduce structural unemployment, which is a market failure? Or does a subsidy actually sometimes lead to more problems than it actually solves? Does it lead to unintended consequences? This is where you're going to bring in the idea of a subsidy leading to possible government failure. So what I've done in this slide is think about 4 types of evaluation arguments. You'll be given the context, you'll be given an industry and market where a subsidy might be used, and you just have to analyse the economics of it and come to a view by asking and by throwing into the air some evaluative questions along the way. And actually with subsidies, it's a really quite interesting topic to look at. There are many, many examples you can draw. So this has been a revision webcast on indirect taxes and subsidies. I hope you found it useful. We've covered a lot in the last 20 minutes or so. If you need to go through this again, please do. It'll be on YouTube, and you'll be able to download the PDF version of the notes. Please come back once more when we have another revision webcast. Thank you.